All right, welcome everyone. Today is Sunday, February 27th, 2022, and this is the follow-up to the options income-based strategies for Quant Trading App hosted by Seth, and he'll be running the show today. Predominantly, focus will be on butterfly spreads as well as a little bit of the option Greeks and just how Seth goes about managing his actual non-directional butterfly spreads. And I'm pretty sure he'll touch on some other topics, but the main focus will be on butterfly spreads. So, Seth, you're welcome to take over from now.
Thanks, Bryant. Hey, everybody. Thanks for joining. Pleasure to share. Yeah, so today's topic should be good. I hope you guys get some good takeaways from it. I definitely think that you can make some good money out of consistent income trading. And the key really in that is consistent. The whole thing about trading for income is that we try to trade mostly without discretion to there's a part of your trading account that should be allocated for directional trades using QTA levels, using opinions, what have you. And then there's a part of your account, in my opinion, that should be focused on generating income without having an opinion on what the market is doing. And SPX is a great vehicle for doing that. And these types of trades that I do, like butterflies, are great for doing that. Putting on a trade, managing your risk, and pulling profits out of the market in a fairly easy fashion. So I'll show you a little example spreadsheet of sort of a trading account that this is similar to what I do. Can you guys see my Excel sheet here?
Yep, we can see it.
Okay, great. So this is an example, trading portfolio, right? Let's say if you had a $25,000 account, this is 80% of this account is allocated for income, 10% of the account is allocated for speculative trades. So, using QTA, using directional trades, as long as all trades are kept with a reasonable size, so that you don't take large losses. One of the reasons why the income here, where it shows 80%, is larger is because income style trades, you normally have more risk. It's an expensive position. You're not trying to reach 50%, 100%, 200%. You're trying to reach like 10% targets or 12% targets or 8% targets, right? So these trades are more expensive to put on, but a little bit easier to manage in the sense of probabilities. So again, this is an example here where, if 80% of my account is allocated for income trades, I might have like a 4-trade plan. And that 4-trade plan is diversified by different strategies, by different durations, by different Greek risks, right? Some might be slightly leaning long delta, some might be slightly leaning short delta, and some are long vega and some are short vega. And I'll explain later if you guys aren't familiar with those terms. But I think the most important part is just having diversification of time frames. The shorter time frame trades you go, the more occurrences you can get and the more trades you can generate and turn over. If I can do one 10 to 15 day butterfly every week and do that over and over every week, right? But I'm that 15-day trade is going to be more sensitive to market movement than a 45-day trade, right? A 45-day trade is going to respond in profit loss terms. It's going to respond a lot less slower. It's going to be much more docile than a 15-day trade. So I generally keep my shorter term trades small and I keep my longer term trades long. So, of this income portfolio, I might have 30% 42 days trades. I might have 30% 35-day trades. I might have 20% 28-day trades, and I might have 20% in 15-day trades. And I reserve some for adjustments. I won't get into nitty gritty on this Excel sheet here, but just an example to show you generally, the smaller time frame we go, the smaller position size I take. When you're managing a lot of money, you got to make sure you don't allocate too much risk into some of the shorter term trades, even though they are fun. And when the market is behaving, You can make a lot of money doing short-term trades over and over. And again, the key is doing it over and over and over. Try not to be too discretional about entry days. Just get in, do your trade, manage your risk, get out, and do it over and over. You know, don't do 15-day butterflies, you know, once or twice and think, oh, that didn't work for me. You know, it's just not my style. Do it and you know, set a plan to say, I'm going to do this every week for the next 6 months, right? And log your results and see how it does. I guarantee you're going to get good at it. If you do the, you know, 25, 30 trades in a row, it's you're going to know how to do it, and it's going to make you money for sure. As far as butterflies are one of the strategies that I do in my, you know, in my monthly trading plan. Really, I could substitute butterflies in any of these buckets here. I could do a 42-day butterfly, or I could do a 15-day butterfly, or I could do a 15-day calendar. It really doesn't matter. They're all kind of the same purpose, right? To generate income primarily through theta decay, through time decay. I might choose a butterfly because I already have a condor on, or I might choose a butterfly because I already have a calendar on. I also might want to choose short vega trades like condors and butterflies when volatility is relatively high. And I might want to choose long vega trades like calendars or diagonals when volatility is relatively low. And I'll show examples of that. So I'll show an example of the butterflies I've taken this month. I've done 4 butterflies in February. I've closed 3 of them. One I just opened on Friday. For example, I did a 19-day butterfly on February 3rd. I closed that for 8%. I did a 46-day butterfly on Valentine's Day. I closed that 8 days later for 15%. And I did a 27-day butterfly on the 22nd. I closed that the next day for 7%. So usually I'm shooting for around 8 to 12 to 15% profit on these butterflies generally. But if the market moves wildly in one direction and I have a decent profit, I might just play it safe, cut my risk off the table, and just take a profit. And so, you know, every 3 of those butterflies I closed out at a profit this month. They're all, you know, had nice profits in them. I'll show you the days that I did those. So if you look at my Thinkorswim here, this was the first butterfly I did. This was, again, a 19-day butterfly. Exited here. This here was a 46-day butterfly, exited here. And this was a 27-day butterfly, and I exited here the next day. So in each of these 3 trades, one of them basically we didn't have much direction. One of them we had initial up direction and then down direction. And then this day here, we had this trade here by mostly down direction. So we had sideways movement, we had both direction movement on one, and then we had down movement on the other one, and all 3 were profitable, right? My point is you can make money in many market environments without calling tops or bottoms or calling direction. You can just collect income using trades like this. Most trading environments, I would say butterflies are good when you trade stuff like indexes. You know, I trade mostly SPX or Russell 2000 because, you know, the SPX represents a basket of 505 stocks. It's well diversified. It has decent volatility that you can trade income trades with, but it doesn't wildly move around like a single stock. So you don't have risks that single stocks would have. I would say most of the time, the indexes behave in a way that is conducive to income trading. The times when it's not conducive to income trading is probably this environment right now, right? We're seeing some fast down moves. We're seeing some quick bounces back up. You know, this whole past 2 months has not been easy for non-directional trades. February, for whatever reason, was good for me. I'm profitable this month, even though we've had some really fast down moves. But I think what kept me profitable this month was just longer term trades. So if you look back at my trading plan here, you know, I may plan to do 1 42-day trade per month, and I may plan to do 4 15-day trades per month. But if the market is moving wildly and it looks like it's just going to drop too fast or bounce up too quickly, I'll either stay out or I will reduce my position size to reduce my risk a little bit, or I'll just go longer term, right? So instead of doing a 15-day trade, let's say I make a plan to do one 15-day trade per week. Let's say Tuesday comes around, I want to put on my Tuesday butterfly. I'll go 21 days or 28 days, right? Because the market's just moving too much. I don't want that short-term risk, but I do want to play, right? I do want to play the probabilities. I believe these trades work, so I want to get in the market. So I just play it safer, go smaller, go longer term, and that's what I've been doing this month, and it's been a good month. So times to stay out of the market with income trades are, again, when you have these fast down moves. I would say fast up moves do tend to sort of pause at some point and trade sideways. But generally, I would say 80 to 90% of the time, the market is good environment for income trades. So let's go ahead and show some butterflies and how they work. I'm going to go ahead and construct a butterfly here. I'm going to start with a monthly butterfly. So I'm going to start with a 45-day one. So butterflies, we sell at the money options. In this case, we're going to do an iron butterfly, which is selling an at the money call and at the money put. And I'm going to actually, let's not do the 5 strikes. Let's go to 10 strikes. So I'm going to sell the 43.80, 43.80. If I want to do an 80-point wide butterfly, I would then buy a long put 80 points lower. So I'm going to buy the 4,300. And then I'm going to buy an 80-point wing, 80 points higher in the calls. Turn these off here. Okay, so this is, let's see, what did I mess up here? 43.80, 43.80. Oh, okay. I should have gone, the long call should have been 44.60. There we are. So the strikes are at the money, or at least close to at the money, the short strikes, and the long call, I have 180 points lower, and I have 180 points higher, a long call up here and a long put down here. So this is called a balanced butterfly, meaning that your long options are equidistant from your short at the money options. The reason why butterflies work is because the most extrinsic value in the option chain lies at the money options, and we're selling that extrinsic value. So if you guys don't know what extrinsic value means, I'll show you quickly. It's helpful to show you what intrinsic value means. So if I turn on intrinsic value in this option chain, all out of the money options have 0 intrinsic value. All in the money options have some intrinsic value. Okay, intrinsic value means that if SPX, if I held this 43.80 call option, if I bought this option and I held it to expiration and SPX closed at 43.81, then that call option will have $1 worth of intrinsic value. That means that I have the right to buy 100 shares of the stock. SPX is not a stock, but let's pretend it was a stock. I have I have the right to buy 100 shares of stock at 43.80 because that's the strike that I bought. And if SPS expires at 43.81, that means that I make $1 times 100, right? So I have $1 of intrinsic value in that option. Okay, and your intrinsic value increases as you go further inside the option chain. Out of the money options have no intrinsic value. Out of the money options are totally extrinsic, right? The options obviously have value, but all that value is extrinsic, right? So the value of the option minus the intrinsic is the extrinsic, okay? So if we show the extrinsic value here, the extrinsic value is the highest at the money option, right? Because if all options in the option chain have extrinsic value, and all other money options have, the most extrinsic value, the at the money is going to be priced the highest, and the at the money is going to have the highest extrinsic value. Okay, so that's what we're selling. We're selling this really, really rich extrinsic value right at the money. Okay, and as time goes on, that extrinsic value wants to decay towards zero, right? All as you saw when we showed the intrinsic value here, it was all zero, right? All those options want to go to zero at expiration. And that's what we're profiting from those options going from $137 in extrinsic value down to zero. Okay. So the goal here is to put on this position and basically, collect all this extrinsic value that we see right here. And as time goes by, we're going to start seeing our profit increase. As long as we stay within this tent, this is all profit here, right? We collect, this much in theta per day. So if you're not familiar with what this graph is, this is the analyze page in TOS. This is the risk profile. The horizontal axis is the price of SPX. The vertical axis is profit or loss in dollars. And the blue line is the profit or loss of your position at expiration, which in this case is April 14th. And the purple line, which is what we call the T+0 line, is today's value of the position, depending on where SPX lies. Right. So as you can see, as we pan forward through the days, that T+0 line starts to accumulate profit. So if we look at the probability components of this butterfly, you might look at this and think, this is scary because this is a low probability trade, and it is. So if this expires, so if today's February 27th, and we go up to this date right here, and we put this on February 28th, what this risk profile is showing us is a 1 standard deviation expected move within the next 24 hours. So this gray window that you see here is what the market is predicting, generally what what SPX is going to close at in 24 hours, either down somewhere in the window here is roughly a 68% chance, one standard deviation chance, right? So this is just for 1 day, right? If we show 2 days, that's the range. That's the range in 3 days, right? So this is a 45-day trade. There's no way we can expect to, close within this little tent right here in 45 days, right? This is an extremely low probability trade, all right? But it's high probability when managed early. There's no way we're going to hold this for 45 days. We're not even going to hold this for probably 30 days. We're probably going to hold this somewhere between 1 to 20 days, probably, maybe 1 to 16 days. As we pan through the days right here, and we see the curve start to accumulate a profit, all we got to do is just close it out when we're in profit here, right? And this curve has profit potential well beyond this expiration tent, right? So when you look at a butterfly, the expiration tent doesn't really matter, right? What matters is this purple line. What matters is the T+0 line, right? Today's profit. And with a 45-day trade, this curve is very, very flat. So even if the market moves down, so if we go back to, if this is 1 standard deviation here, the market moves down tomorrow, 1 standard deviation, which is a decent size move, we'd be in profit theoretically, right? If it moves up, we'd have a little bit of loss. If it moves down 2 standard deviations, we'd still be in profit. Compare that to, so that was a 45-day trade. I'm going to model up a 15-day trade. Again, this is an iron butterfly, which means we're selling a put spread and a call spread. So sell, buy. So again, the same exact structure in this one. It was selling at the money call and put. It was buying a call 80 points lower. I'm sorry, buying a put 80 points lower, buying a call 80 points higher, same exact structure, same exact width. If you look at the width here, it should be the exact same graph. What's different is you get a lower credit on the short-term trade. And this T+0 line, see how it's more skewed here? See how we have a higher profit on this side and a greater loss on this side? That's because there's only 15 days in this trade. And this curve is going to want to match that expiration curve quicker, right? So this curve will start to form to this tent shape much more quicker on a 15-day trade than it would on a 45-day trade. So even though the range, so to speak, is the same on these trades, the 15-day trade has more risk because with a given move, you're going to be up more or down more. And so there's more volatility early, you know, for the life that you hold this trade. Again, this is a balanced butterfly. This is the 45-day trade again. Classically, a lot of people that trade income trades will trade these as unbalanced, and that's the way I do them as well. And the reason why we do them unbalanced is because of the way the volatility indexes are structured and the volatility skews are in the indexes. When you put on a non-directional trade that's balanced like this, you end up having a decent amount of short delta risk. What that means is that my position delta here is negative, right? Which is good, but in a balanced trade, it's oftentimes a little bit too negative. So what that means is that if I'm short delta, that means as the market moves up, I lose $1.63 for each dollar the SPX moves down, okay? Or I gain $1.63 for each point the SPX moves the other way. That's short delta. I generally, when I do non-directional trade, want to have about -1 to -2 delta risk per $1,000 at risk. So sort of a general rule of thumb that I use to check trades. Okay, you should write that down for yourself. That's a good rule of thumb. Can anyone tell me why I want to be net short 1 or 2 delta when I do a trade like a butterfly? Anyone have any guesses? Okay. So,
Brian.
Yeah.
Seth, is it
Okay.
because the like theta is not as great of a risk to delta?
That's not the reason. No.
Okay.
No. So this is a short Vega trade, meaning that the volatility increases, I lose money on this trade, right? From volatility alone. Okay. I have negative Vega right here of 31. Look at that's the 45-day trade. My Veganess is actually even more steep on this 15-day trade here. If on the contrary, volatility increases, the premiums would decrease. And since I'm net short Vega here, I would profit from volatility decreasing on this. Okay. So even though as an income trader, the style that I do generally, my primary objective is to accumulate profit through theta decay. I would say the secondary goal of an income trader is to collect profit through Vega. So you generally want to sell butterflies when VIX is relatively high, or when the volatility of the underlying instrument is relatively high, not too high, but I would say just relatively high. So if my Vega is negative, so I have negative Vega risk on this trade, then I want to balance it out with a negative delta risk. Okay. So as the market moves up, volatility generally contracts, right? Which would be good for me in this position. So as the market moves up, I'm going to lose on delta because I'm short delta, but I'm going to gain in Vega, right? On the contrary, on the other side, I'm long delta, so I'm going to profit as the market moves down based on delta, but I'm going to lose the market moves down if volatility increases, which it usually does when the market moves down. Okay, so that's sort of a way to balance out the delta and the vega risk. So with a short vega trade, you want to have short delta. With a long vega trade, like a calendar or diagonal, double diagonal, you want to balance that out by having a slightly long delta bias when you first initiate it. To what degree do you want to offset those? Like I said, it's about -1 to -2 on a short vega trade. And the opposite for a calendar, I would generally want to be long about 1 or 2 delta on a calendar for every $1,000 at risk, right? So this is about $1,000 at risk right here. It's 1180 for this trade here. So I generally want to target on this 15-day butterfly about -1 to -2 delta. And as you can see here, I'm short almost 4 delta here. Okay. The way I modify this trade when I initially set it up is by making it unbalanced on the upside. And we do that by bringing in this long call side in. So this was an 80 wide wing on the put side, an 80 wide wing on the call side. I'm going to change this to a 70 wide wing. Okay. So I'm going to bring in my long call down 10 points. So now I have 80 points here and I have 70 points here. And I'm now right at about my target right here. I'm about, between -1 and -2, which is what I wanted. Okay. And these numbers you can sort of use your discretion when you set up these trades. How much delta risk do you want to take at the beginning, right? If you think the market is just really due for a bounce tomorrow, either you don't do non-directional, or if you do non-directional, then have your delta risk be closer to 0, right? Maybe -1, maybe 0, maybe positive 0.5 or something, right? Anywhere between -3 and +3 is still neutral, but you want to favor having short delta at trade entry on a short vega trade. But again, you can skew that a little bit if you're leaning one way or the other. And I do that, but generally I still always look at this number here. I still always want to be about -1. That's usually my target. I set up a butterfly trade on Friday and on SPX, and might not have been the best day for butterfly because the market moved pretty quickly to the upside. But when I set, I was aware of the upward momentum, and when I set it up, I think I was -0.5 delta when I set it up, right? So that just reduces the pain a little bit on the upside as the market moves up. These are the finer points. It's not going to make you or break you on the trade, but it may or may not put the odds in your favor if you sort of tweak the deltas a little bit. But to start out with, just aim for -1 to -2 delta per butterfly or per $1,000 at risk. Okay, so I'll show you how we calculate the profit loss targets on this. So with the credit spread, which is what an iron butterfly is, a credit type transaction. The two at the money options that you're selling are more expensive than the out of the money options. Okay, so the net transaction is going to be your credit. Okay, because you're selling more than you're buying. Okay, and the way the trade structure is calculated as far as the margin goes is it's the wing width of the biggest wing minus the credit received is the position margin. Okay, so in this case, if our wing width is $80, it was $80 on the put side, and the credit was $63.75. Your margin again would be equals your wing width minus your credit. So your margin should be 1625. Let's see if that was correct. Yep. So 1625 times 100 is 1,625. Okay. So So that's what it's going to cost you. Even though you're going to get credit for this trade, the broker is going to take out, 1625 from your account, 1,625 from your account. It's going to hold that back as buying power in order to put this trade on, because that's the max you can lose is 1625.
Seth, just to make sure that everyone caught that, the 1625, again, as you glanced on the risk profile, just show them that window where it says 1625 is the cyan color. So when he said, yep, guys, you see where it says 1625 right there to the left, that's how he knew it matched up. And that's just because at expiration, that's what the P&L would be if the SPX was at that level.
Yeah, thanks, Brian.
No problem.
Yeah, so that's 1625 is the most you can lose on this position. Okay, it's a defined risk trade. And then for the profit target, I would shoot for a 15-day trade. I'd stick on the lower end of profit targets. I'd go with like 8 to 10%. So let's go 10% profit target, and that's 10% on the trade cost or the buying power reduction or the margin. It's all the same thing. Okay, so if I'm going for a 10% profit target, then I'm going to do profit target is going to be 16.5 times 10. So I'm going to try to make $1.63, or let's just do this times 100. So my profit target is $162. Okay. If I stand to lose, so if my max loss, I would not, when you do income trades like this, I would try not to exceed a ratio of about 1.5 max loss to profit target. Otherwise, your losses are going to hurt more. So that even though you might have a 70 to 80% win rate on your trades, when those losses, when you do get those losses, which do happen all the time, the key is you don't want those losses to, wipe out, 3 to 4 to 5 trades, right? You only want it to wipe out like 1 or 2 trades. So I would go from, if my profit target is 10%, I would set my max loss as a ratio of that 1.2 to 1.5 times the profit target. Okay. So let's go with like a 14% here, right? 1.4 times profit target. So, so I want to make 10%. I'm going to say when the trade hits 14%, I'm going to get out. Okay. So I want to make $162. And I don't want to lose, let's put another column here. Equals margin times. Sorry. Equals margin. Great. So I don't want to lose more than $227. Okay. Now to calculate what my target price is going to be, target price is going to be the it's going to be 10% of the margin, and it's going to be subtracted from the credit. Okay. So if my target price is 100 to 250, I'm going to divide that by 100 to convert that to, a position decimal. And I'm going to, let's see here, go to, great. So essentially 10% off of this margin price is going to be my, sorry guys, it's hard to deal with when I'm talking. That's not correct. It's going to be the margin times, let's just go profit target. And that's going to be subtracted from the credit. So that's going to be B3. That looks better. Great. So if I want to make 160.50, I'm going to end up selling, I'm going to end up buying back this credit spread for 62.13, right? If I'm selling it at this, I want to buy it back lower, and I want to buy it back at a lower price in order to hit my profit, right? So I know I kind of fumbled through that, but basic math, right? And the stop price would just be the opposite of that. You would basically add 14% of the margin to this, and that would be the max price you would get it out at. Okay, so it's important to set these target prices and stop prices up right after you enter the trade, because you want to know when you go to close out your trade, where to get out of that, right? And so usually when I set up a trade like this, I'll immediately go in and set an opposite good till cancel order at my profit target, right? So if I enter this at 63.75, I'm going to go back in, create opposite order. I'm gonna try to get out for 62.10, right? And leave that as a limit order until it fills, right? Unless the trade moves against me, and I'm looking at my T+0 line and I'm seeing I'm around, I'm around a 220, 230 max loss. And what I do is I go cancel, replace that profit order, and I exit at my stop price again, which is going to be 14% of the margin, in addition to this here. So it's good to have these prices written down so you know what price to get out at. Okay, and so I have, like, as you can see in this trade log that I showed you, I have all these formulas in my spreadsheet here. So anytime I enter a trade, if I enter, if I set my max loss at 15, 12% or whatever, it calculates what the stop price is, what the profit target is, what the max loss is. Okay, so I always keep, anytime I put an income trade on, I put on these figures here so I know what to get out at. Okay, so let's talk about, so that's the first step, first few steps. Put the trade on. Step number 2, determine what your profit target is, determine what your max loss is, set your limit order out to get at a profit, and then keep track of what your max loss is, right? Next step is, if the trade starts going against you, what do? Okay, you can choose to either let it go against you until it hits your max loss, or in the case of a butterfly, which is a low probability trade, I would manage this when it hits the break even. Okay, a break even, I mean where the blue line crosses the horizontal line, the 0 line here, right? Anything below the 0 line is a loss. Okay, so as the market starts moving around, you can see you'll either be at a profit or a loss. And a lot of trading plans with respect to butterflies will have you make adjustments when you cross the break even. And the reason for that is because you generally want to keep the trade under the 10. Okay, with a short vega trade, no matter what you do to the trade, as long as you keep it under the tent, it'll want to collect profit for you, right? If you can keep managing it and keep the risk low and keep it under your tent without incurring too many costs as you keep it under that tent, the profit's the position's going to accumulate profit for you. Okay, so we want to address it when it reaches the tent, the outside edge of the tent, the break even. Okay, and there's a few different ways to do that. There's actually lots of different ways to do that. I'll share with you a couple that I use the most. And
to hate the Russians and hate Vladimir Putin.
So this is the butterfly that I put on Friday. And when I initiated it, it was in the center. And as the market moved up that same day, as you can see in the futures right here, this little chart, it reached my break even right here and sort of stalled out there for most of the day. And once it reached that break even, I thought, okay, it's probably time for me to adjust it. But I thought, okay, I'm not going to adjust it too much. I'm going to extend my tent a little bit. So what I did is I rolled out my call spread further out. So my trade now looks like this. So what I did is I bought back one of these short calls. I bought back a short call and sold the long call. So I basically bought back that call credit spread, and I resold a new call credit spread 40 points higher. Okay, so if I'm in a trade here where let's go to my 45-day chain here. Well, that was a 27-day butterfly I did. So you can see my butterfly right here, the one that I was just showing on the graph. Here's my long put, here's my short put, here's my short call, here's my long call. As you can see, the price moved up, so both puts became out of the money and then my call option started moving in the money. Okay. So if I wanted to move that call spread further out, I would buy back the short call. I would sell the long call. And then I would go 40 points higher to, so this is 43.40. I would go to 43.80. I'd sell a new short one. And then my initial wing width was 70. So I'm going to go to the 44.50. So if I'm selling the 43.80, I'm going to buy the 44.50. So again, I'm buying back this call spread. I'm selling a new call spread, 40 points higher, 70 wide spread. And this is actually, it's a condor, right? Is what that is, right? Basically buying a condor here. So that's what that would look like, right? If I were to do that trade again, I would just extend that call spread out. And you can do this indefinitely, right? When especially in a 45-day trade, when the market reaches your break even, you're not really going to be down that much normally, right? I was probably only down $100 or $200 when it reached my break even, right? That wasn't a disastrous loss percentage on this trade, right? I think I stood to loss on this trade. My max loss was 1,600. Okay, so I wasn't even close to my max loss by any stretch, but I need to do something because I want to keep it under the tent, right? And so what I did again was I just moved that call spread out, right? So it gives me a little bit more room, not a ton of room. It gives me some more room to where the trade could live there indefinitely. If it starts to move against me, then I'll adjust it again and move that call spread out, right? And you can keep doing that indefinitely 6, 7, 8 times if you need to, in order to keep it under the tent. Eventually it's going to come back down, right? Eventually, it's going to come back down. And as you can see, this is a short delta area right here, right? Since my slope is leaning downward to the right, this is short delta. So if the price retraces back, I'm going to start seeing profit, right? So in an environment where, the market, you think the market action is sort of two-way and it's not just blasting up to one side, this is a great adjustment strategy. And this is normally what I do on monthly trades. Because the profit loss figures aren't, wildly responsive to the market movement. The adjustments are sort of easy. You're not at a big of a loss. So I can just sort of keep moving these spreads, one after the other until eventually it accumulates profit. And it might not, right? The market just might keep moving against you, and then you have to cut it out, cut out at a loss, right? So that's one way to do it. And you can do that over and over. This T+0 curve is still very flat. At some point, you do need to address the delta risk. Okay. So what I just described to you, that management strategy of just moving out the call spread, is not even considering really what the delta risk is, because that curve is so flat, the delta is not going to be overall very high, right? My loss isn't great. The delta risk isn't great. I'm just basically looking at the graph visually and saying, okay, I need to keep it below the 10, all right? But at some point, as the trade ages, this curve starts to look like the expiration curve. My delta risk gets bigger, right? The slope is greater than it was 10 days earlier, okay? So at some point, the delta gets too high and it needs to be addressed, because your position is then now subject to more wild price swings as the market moves. And if you're a non-directional trader, you don't want to really be that subject to price movement, right? You want to keep that delta risk low, okay? And to answer your question, Nick, I just noticed your question down the side. Yes, I do this on the downside as well. So at some point, when the delta risk gets too big, you need to address it. And that delta risk parameter to me is about 15, right? When the position delta gets to about 15 per lot is when I adjust it, okay? So this is a 10 lot trade. This is 10 contracts here. So when the delta risk gets to either positive 150 or negative 150, then that's the point where I say, okay, that delta risk is too high. I need to do something, okay? And in that case, so as you can see, yeah, this is too much delta risk right here. But again, this is this is long into the trade. This is typically your delta related adjustments in a butterfly come later in the trade because that line is so flat. Okay, so you might initially start managing it by moving call spreads out, but as the trade ages, if you need to, keep an eye on this position delta here and adjust it when it gets to 15 per lot. And the adjustment that we do here is not moving the call spread, because when you move the call spread, it actually increases your delta risk, right? So, if our trade were here and we move that call spread out, look at the delta here. It starts at 149. By moving out that call spread, it went up to 199. Okay, so if I just stated that our delta risk, like cutoff point is 150, then I need to do something, and I definitely don't want to increase delta risk, right? What I do is then I roll only the short call outs in the direction of the market. Okay, and so what I would do at this point is I would go to, so let's see, I'm short the 43.80. I would buy back the short call. Oh, that's not right. I'm short the 43.40. That's what I'm short here. So I would go to the 43.40 and I would buy that back. And I would roll that out further. And let's roll it out by about, let's try 20 points. So I'm going to now short a higher call. Let's try that again. Buy this back. I'm going to go 20 points further and sell this one. So I'm just basically rolling the short call further. And if I multiply that times 10, since I have 10 lots. So again, that achieves our objective by reducing the delta. Okay, so we were at 199 before, and that's what that does is that basically cuts out my delta by almost half, which is a good target. When you make an adjustment on a long-term trade, you generally want to target about a 50 to 75% position delta reduction. Okay, you don't want to adjust it usually all the way to zero, and you don't want to adjust. You don't want to flip the delta, right? You don't want your curve to look like this, because what you're going to do is you're going to subject your trade to more whipsaws, right? You basically want to say, okay, the trade should start coming back, but it's not. But I need to do something, and I need to reduce my risk, right? So I needed to reduce my delta exposure in that direction, but I'm not going to reverse it, because if I reverse it, then the trade might whipsaw and I'll be even more of a loss. Okay, I'm just going to cut my risk down a little bit. So what I did here was, by rolling the short call out further, is I essentially decreased the width of this call spread here by 20 points, right? This was a 70-point wing. I just reduced it to a 50-point wing. And if you know anything about credit spreads, the wider the wing, the more risk you take, right? So since I have a smaller wing here, I essentially have a smaller risk on this side. I take more risk on this side, but I can address that if that happens, right? I'm not worried about this side right now. What I'm worried about is this side. This is the side that's losing, and this is the side that has all the delta risk. So I don't really care about what's going on here. I care about what's happening here, and I need to adjust the risk over here. Okay, so to recap, we started here as the market moved out of our tent. We rolled the call spread out. We do that as many times as necessary until the delta gets to about 15 per lot, and then it's time to roll the short puts out to reduce delta risk. Okay, and you can sort of do this over and over. You can do both of those adjustments over and over, keeping the trade below the tent until you hit your profit target or until you hit your max loss. Anytime you make these adjustments, you'll see your trade margin will generally go up, right? So this margin here is 29,000. My initial margin was 13,000. So generally, when you do adjustments of this nature, you're adding capital to the trade, especially with butterflies. You're adding capital to the trade. So you have to make sure, if you're going to trade a butterfly and you plan on adjusting it, which I suggest you do, plan to have some capital put aside for this. Okay, so if I look at my butterfly plan, do I have a butterfly in here? So if I have, if I know I'm going to do a 42-day butterfly, and I basically can say, okay, I want to reserve like 50% more of that trade for adjustments. So what that does is that reduces my initial position margin I allocate to that trade. So instead of allocating, 6,000 to the trade, I might initially enter it at a $4,000 trade, knowing that I have additional cushion there to make adjustments with. And that's a very, very smart thing to do. So again, make your adjustments, keep them in the tent, right? And then close it out at max profit or close it out at your max loss. Don't adjust your max loss targets based on the new margin. Okay, that's you're just going to end up losing more, right? If you didn't want to lose more than $1,000 on this trade, don't increase your max loss as you increase the margin. Just stick to that max loss, right? You're only doing adjustments to stay in the trade longer and to increase your chances of profit. And you're not doing it because you're just you're not trying to just lob more money in the trade. You're trying to stay in the trade long enough to work in your favor. As you can see, when we do these adjustments each time, we're adding theta to the trade, right? If our theta here was 108, by keeping it in the tent, we just added more theta here. It increased the margin, but it added more theta decay to our trade. Okay, so when we do these adjustments, we want to add theta whenever possible to our trade and keep and widen the tent in our trade to increase our chances of it working for us. Okay, so that's management method number one. Another great management method is let's do a 15-day trade here. Let's close these out. Okay, so here's the 15-day trade I modeled up a little bit ago. And so again, that management style that I mentioned, I use that more on monthly trades because it's easy to do. And that's fine to do on short-term trades as well. But a really fun method I like to do on short-term trades, which I think you guys are gonna like, is different. So let's say the market again moves to my adjustment point, which is at the break even. Instead of rolling the call spread out, what I'm gonna do is I'm gonna add another OTM butterfly. So when it gets to this point, I'm gonna add another butterfly about 40 points away out here. Okay, so if this one is sent, so this is the 14 March, centered at 43.80. So let me go to the 14 March. Okay, so here's my option chain. And so let's say the market moves to, let's say it moves to 44.40. And I determined that since it reached the break even, it's time for me to adjust by adding a butterfly. I'm going to add another butterfly centered 40 points higher. So I'm going to center it at 44.80. Okay. So I'm going to sell, and this is going to be an all call butterfly. I'm going to sell 2. I'm going to keep the wing width the same. So again, it's going to be an 80 downside, 70 upside. So it's going to be 4,400 for the long on the downside. And it's going to be a 45.50 on the upside. 80 points below, 70 points above. And there we have a double butterfly. So look what happened here. We initially had one butterfly with a theta of 28. Our delta is negative 2.4. When we add this adjustment, we reduce our delta risk. Okay, because we're adding an out of the money butterfly. So that butterfly should generally profit as the market moves up towards it. So it's going to reduce our delta risk. Okay, if we were short negative 2.4, we've now cut that in half, which is a great target for reducing delta. Okay, and look at our theta. It went from 28 to 54. So we now just dramatically increase the profitability window in our double butterfly. right? We doubled the capital. You know, our max risk is now 3560, where before it was 1600. So we've more than doubled the capital, but we've given ourselves a very wide profitable window, right? And again, here, I would stick with the original profit target, original max loss, right? So if your profit target here was, if this was 1600 in margin, let's say I wanted to target 10%. So I want to target $160 profit on this. So again, after the adjustment, I would still hold this until I reach $160 profit. Okay. And this tends to work out pretty well. Once you do this adjustment, you now have a very wide range. And if the market keeps moving, then you adjust it further. And so if the market keeps moving, let's say keeps moving up, once it reaches about where your short strike is, close the lower one. Okay. When it reaches here, this butterfly is probably going to be profitable, and this one's not going to be for sure. Okay. So you're going to close out the one that's hurting you. You're going to close the painful one, which is this bottom one here. All right. And then you go back to one butterfly. Right. The opposite is true. If the market moves down, let's say you put on the adjustment, the market retraces, which it often does, and you close out the upper one. Okay. And if it goes back, then you open another OTM butterfly 40 points lower, or if it goes back to this break even, open another OTM butterfly 40 points higher again, right? And you can basically do this over and over, and you're just like moving the goalposts every time, right? You want to keep the ball between the goalposts the whole time, and just move the goalposts when necessary to keep it between the posts. And this is a really fun way, especially with short-term trades. It's really nice because when the market is moving against you, once you reach the break even, you might be at a loss that's not comfortable, and when you give yourself more room, it's like, you just gave yourself a lot more breathing room. That's a really fun way to trade. And visually, it's just fun to sort of watch it, stay between the strikes and stuff. But on something like a 15-day trade, you wouldn't want to make, I would say, more than 2, maybe 3 max adjustments, because as the trade ages and you approach expiration, once you get into like the last 4 or 5 days of a 15-day trade, all your Greeks are going to increase in risk, right? Or not all your Greeks, but your gamma and your delta primarily are going to increase, right? The slope will get more severe, which means your delta risk is higher, which means for a given market movement, your trade is going to profit or loss more or less, and your gamma is higher. Gamma, again, is a derivative of delta. So what gamma means is gamma represents for every $1 move in the underlying, delta is going to increase or decrease by X, and that X is gamma. So delta changes, and gamma represents how much delta changes. Okay. So your delta is going to change faster and faster as your trade ages. So that means your gamma risk gets higher. Okay. So delta and gamma are the 2 risks primarily that you're dealing with when you're managing these trades. I don't have any criteria figures for gamma, but just know as a concept, gamma risk increases as the trade ages. So back to my point of adjustment quantity, don't plan to make, I would say more than 3. Any more than 2 adjustments on a short-term trade, like a 15-day trade, you're probably not going to be in good shape anyway. You're probably going to be close to your max loss anyway. So I would say don't plan to make more than 2 adjustments like this, and then just be ready to close it out if it hits your max loss. You can also do this management method on long-term trades as well. That's totally fine. For whatever reason, I just like doing this method for short-term trades, and I like doing the other method for long-term trades. Both methods work for both short and long-term trades. Regarding timeframes, again, I showed you an example of a 45-day trade, I believe, and I showed you an example of a 15-day trade. If you're going to start out with butterflies, I would start out longer term, right? Just allocate $400, $600, $1,000, whatever you can afford to either a SPY or a SPX butterfly. And I would say for your first one, do at least 30 days, right? It's just going to be easier to manage. If you have the patience to do a 42-day trade, even better. You can even go 50, 55, 60 days, right? But I do also recommend you practice with short-term trades as well once you get better with the long-term ones, because they're really fun. Because when you can put on a 15-day trade once a week and do that over and over, you can start collecting, 10% profit on Tuesday, 10% on profit the next Tuesday, 10% profit the following Tuesday, and really start accumulating a lot of profits, right? You definitely get losses, but you might average 4, 5, 6% once you factor in all winners and losers per trade made, right? And do that over and over. If you do that once per week, you can get 4 10% trades in 1 month, in a good month, right? And that's a great month. You can make a lot of money doing that. Okay, so I'm going to take a break. That's about all I had to present. So I'm going to go ahead and see if I can address some of your questions. Okay, so JK asks, what if the wing widths are not equal to average? Not sure what you mean by that. If you could clarify what you mean by that, that'd be good. Millennial Trades, if you want me to share my spreadsheet, certainly. Send me a DM to remind me after the webinar, and I'll send it to you. Okay, so Jay says that you had to do with your Excel calc. Still not sure what you mean. Oh, okay. So if you're referring to the wing width determining the margin, yes. I think on an all call butterfly, no, on an iron butterfly, whatever your biggest wing is what determines is used for calculating your margin, right? So my biggest wing here is 80, and so again, 80 minus the credit is your max loss. So whatever the bigger wing width is, doesn't matter if you have a 70 on there, but when you do put a 70 on, it does skew this deeper. So it does make the max risk larger, but that's all calculated out. Let's see. How wide wings would you go with SPY? So if I did it on SPY, I would just divide everything by 10. If I did it on SPY, instead of doing 80-point wings, I would do 8-point wings. Instead of doing 7-point wings, instead of doing 70-point wings, I do 7-point wings. Okay. One point I didn't make is that, when I showed you the 45-day butterfly, I set that up as an iron butterfly. Really, there's no difference in trade management or profitability or the success of your trade, whether it's an all call butterfly, whether it's an all put butterfly, or whether it's an iron butterfly. So iron butterfly just means that you're selling an at the money call spread here, and you're selling an at the money put spread here. All right. And all call butterfly just means you're selling 2 calls, right? And you're buying your wings all on the call side. So it's just like a butterfly. It's just they're all on calls. And you do the same thing on puts too. You sell 2 at the money puts and then buy in the money put, buy out of the money put, and buy in the money put. Okay. It really doesn't matter. However, if I have a preference, I would choose iron. And the reason why is because you tend to get more open interest and liquidity in the out of the money options than you do in the in the money options. Okay. So if I have an iron butterfly, I don't have any in the money options, right? I might have one in the money. It might be here, right? But generally it's at the money, okay? But everything's out of the money, right? The longs are out of the money initially, okay? If I didn't all call butterfly, I'm gonna invariably have one that's deep in the money, right? I'm gonna have one that's at least 80 points deep in the money right here. And as the trade moves, that can get even further deep in the money, okay? And generally you'll see the open interest start to fall a little bit in the money options, more so than the other money options. So for that reason, I just think to put the odds in your favor, it's better to stick with the iron butterfly. For short-term trades, I usually do all call butterflies. And the reason why is because, like I explained, when I do the double butterfly management method, I might start with this as an all call. And then when I do when the market moves up, I might do the other one as an all put, right? And so then I now have a butterfly on the call side, butterfly on the put side, and it's just nice and easy for me to track which one is which, right? And I don't have a risk of missing up my strikes, which can happen. You want to make sure when you make adjustments or when you add butterflies, you don't accidentally buy back or sell an option that you meant to hold. So it's just sort of one neat way of keeping track of it if you just keep them all to one side if you're planning on doing this this OTM method here. Someone asked, when day and time is ideal to place the weekly butterflies 15 days out? How do you put the short strikes when the market is so uncertain these days? Okay, so good question. The ideal time to do non-directional trades is when the market is in a range, okay, or when the market is mildly trending, right? You can manage trades if the market is behaving nicely and sort of crawling up at a nice easy pace, or even has a little bit of two-way action, or even if it's not trending, but you have some sideways movement, as long as the range is as long as it's generally range bound, that's like perfect weather for income trading, right? When you get a lot of volatility, which is like what we're in this environment now, it can still be good for income trading, but you got to go further out in time. I would generally say this February has been not ideal for range bound trading, but like I explained earlier, it's been good for me. It worked out okay. I did longer term. I had some good trades. I would not be doing 15-day trades in this environment right now. I would be doing, I would say for my shortest term trade right now, I probably would not go shorter than maybe 25, 28 days to be safe. That said, I did do what did I do? I think I did a 16-day butterfly. I did a 19-day butterfly on the 3rd. But that's after we had seen some two-way action here, right? Also, I track the ATR. So in this white indicator here, this is the average true range. This is an 8-day average true range, which represents sort of the range of high, low, and closing prices of the recent X amount of days. And when the ATR is rising, that means that the range of all the bars is increasing, right? And it's going to start to threaten my non-directional trades, right? If the ATR is stable, or if the ATR is declining, if I could place an income trade when the ATR is high, then the ATR starts to go low, right? That would represent some slowing down of action. That's perfect income trading weather right there, right? That's absolutely perfect. So you want to be cautious of, if you're going to do income trading, I suggest you have an ATR indicator on your chart. If you start to see it incline, that's when it's time to look out, right? Either stay out of the market, or just be careful. Go smaller size, go longer term, right? Like I said, this is not 15-day trade weather right here. I would say, most of 2021 was good income trading, right? This is all great income trading for like 15 days trades, right? I was doing a lot of 10-day trades, a lot of 14-day trades, a lot of 15-day trades over and over every week, right? I think for most of 2021, I would do like a 10-day calendar on Tuesdays, and I would do a 15-day calendar on Thursdays. And I did that over and over for almost a year. And sometimes I would substitute those with butterflies. Doesn't really matter. But that was a great environment for that slow, sort of like strong, steady uptrend that's somewhat predictable. That was good for short-term trades. Okay. Like I said, right now I would go longer term. In addition to that, I would prefer to enter on a down day, because you want to, since it's a short vega trade, you want to sell when volatility is high, because since if volatility decreases, when it decreases, it's going to be in your favor, right? So I generally want to sell butterflies when volatility is high, and I want to do the opposite for calendars. I want to buy calendars when volatility is relatively low, right? So as you can see in my TOS screen right here, I always have a chart of VIX, and I plot the support resistance of VIX here, and you can see it's been between 16 and 32 for a long time now. And you know, I'd look at sort of where is VIX relative to its recent channel, where is VIX relative to its recent range here. And right now, VIX is in the higher, you know, 30% of its recent range, right? So for me, this is ideal butterfly weather right here. I prefer not to do calendars here. I have, but I prefer not to. I'd rather do calendars down here. I'd rather do butterflies up here. When I'm in the middle, I would do both. That said, I wouldn't just do all short Vega trades. I still would diversify by doing at least something long Vega, right? Just to diversify my Vega risk, right? If I have 4 trades on, I might want to have 1 small calendar on, just to make sure I'm not leaning all one bias in Vega, okay? As far as strike selection goes, it's always at the money, right? I always do butterflies at the money. If it's a non-directional trade, most of the time butterflies are going to be at the money, and the wing width is going to be the same, at least in this environment. I'm going to go 80 on the downside, 70 on the upside. When volatility starts going back down to the teens again, we start going smaller with the butterflies, but then that sort of changes the management parameters. Nothing wrong with sticking with 80 and 70 for right now. That does well. Okay, let's see some more questions here. In this environment, is it more profitable to iron condors, butterflies, etc., with longer expirations? Yes, it is. Capitalize on theta and close out in 5 to 10 days. Yes. All right. So it looks like, JK, you're asking the question, like, does it make more sense to do 30 to 50 day trades rather than 1 to 3 day trades? Yeah, it is. You know, I do short-term trades, especially, you know, when you're talking about doing a 3-day trades or 1-day trades, you're essentially just playing into the probability game. You're not really playing into the risk management game, okay? When you hold trades closer to expiration, you're basically playing into the zero-sum game where you're saying, you know, buyers and sellers generally have a more equal shot at being right. So when you do a structured derivative trade like an iron condor, what you'll see is if you hold until expiration, you'll see the probabilities sort of work out to what they're saying they work out to, right? You might win 80% of the time, and you might lose 20% of the time as expected. When you manage earlier, you put the odds more in your favor because you manage that T+0 curve. You're no longer managing at the expiration graph, you're managing at that lower purple curve, and you're taking profits early, okay? That puts the odds further in your favor as an option seller, okay? So it's fine to do 3-day trades, but you're not really doing risk management there. You're just doing basically probability trades and just crossing your fingers and hoping that probabilities work out in your favor, okay? If you can do it over and over successfully, you can certainly get big wins, or you can certainly get not big wins, but you can get, you know, high win rate. But when those losses hit you, they're going to be greater, right? If you do a 3-day trade, you take a loss, it's not going to be a 15% loss. It's going to be a 40, 50, 80% loss, right? So those are more volatile. Do you usually have some directional bias when opening your trades? Are they mostly structured around the Greeks? I don't usually have directional bias when I'm opening my trades. With my income trades, I don't. If I'm doing directional trades with QTA, which is, you know, QTA is you know, great for that, and that's why I joined QTA, because you know, I'm not a great directional trader, honestly, and QTA helps with that for sure. But as far as my income trades go, I basically want to hold to my belief that I'm not good at picking direction, and I basically want to just manage my risk, right? And so, no, I don't normally have a bias. Like I said, I do sort of tweak my deltas a little bit, right? I think that's fine to do. I think that's smart to do. I don't expect that to make or break the profitability of my trade. I think it just might put the odds slightly in my favor, right? And then that only comes with experience, right? The more condors you do, the more credit spreads you do, whatever, you start to get a feel for, where you think the market might go, for its support or whatever. But I don't necessarily structure my trades with a strong bias. I would say I do use QTA levels, support resistance levels, and that sort of thing when it comes to adjustments, right? So let's say if I put a butterfly on, and I showed you when we got to the edge of the tent here, right? If we have some, the charts might show there's resistance there, or the community in the QTA Discord is saying, hey, looks like this is the end of the zone here. We might get at resistance. And I might say, okay, I should adjust because my diligent risk management practice says I should adjust, but I'm going to go a little bit easier on my adjustment. So instead of doing the OTM butterfly for this one, right, I'm going to just do a mild adjustment, right? I'm just going to move the call spread out, right? So I can use adjustments sometimes to sort of follow what my opinion might be, but I still adjust, right? I don't not adjust. I have to adjust. If I'm responsible for my money, I have to adjust. Johnny Finton asks, is your max loss and profit target usually always the same for your income trade? Generally, yes, but not exactly. I would say with butterflies and calendars, because the theta is so high and the extrinsic value is so rich right in the center, you can reach those higher profit targets quicker, right? You can get a 10%, 15% profit within a few days. And so I take those. But with something like a condor, if I have a really wide iron condor, let's say I have a condor that started out as like a 10 delta put, 10 delta call. Your max profit potential as a percentage of your trade margin might be 20%, right? The most you can ever make on that trade is 20% of your margin. Okay. So I'm not going to hold that trade to 15% because in order to get to 15% profit target, I'm going to need to be in the trade, 80% of the duration. Okay. I might set my profit target for 10% of that condor because that's only half what the max profit potential is. And I might get out of that in half the duration or less, right? So all that to say is that with stuff like condors, I usually expect to be in them longer if I have a higher profit target. So I usually use a slightly lower profit target. But with stuff like butterflies, I will go above 10, 12, 15% profit target. Let's see. Does that mean, so iPhone or whoever that is says, does that mean management is probably not going to work out as nicely for 1 to 3 day trades? Yes, I would not do butterflies and plan to manage them. I would probably do if I was going to do a 3 day butterfly, either manage them intraday and get out the same day, or just put it on when you wake up the next morning, open up, the screen, see where it's at, and close it out. Hopefully it's at a profit. I don't think there's much opportunity for you to do many adjustments in those very, very short-term trades, unless you're doing them like intraday, watching the market all the time. I do a lot of like 4 and 5 day butterflies, but I do those when I don't have like anything going on at work, and I can just watch the screen all day, right? And I can watch the delta risk, but it's not the same management method. I'm not talking about the management methods I went over today. Managing extremely short-term trades is a much different animal. It's much more, you have to be much more aggressive. You have to cut risk earlier, and you have to get out earlier, or else your losses will just sort of grow out of control too quickly. Will adjustment by doing OTM fly be too late if you wait to do it near the break even? No, it won't. In fact, the break even point is a very good point to adjust at, and doing an OTM fly is a very solid adjustment. The question says, by that time, the loss is already close to max loss. No, it's not. Again, this was a 15-day trade here. As you can see, If the margin was 16.25, let's say I set a 15% max loss on that. So my max loss would be $243, right? So as you can see, I'm halfway there, right? At the break even, I'm only at a 7 or 8% loss right here. Okay. So it is bordering on, you getting a little bit too late for an adjustment, right? If you're gonna adjust, you want to be like at less than 50% of your max loss, right? So this is about the edge of where you want to adjust at. Because if you try to adjust too late, if you're adjusting right at max loss, but you're adjusting 80% max loss, there's not really much opportunity for it to go in your favor. It's probably too late at that point. I would either just close it out or, just make an adjustment with the hopes of just recovering a little bit of profit. But when you do adjustments, you can't expect to, save the life of somebody who's been stabbed and is already almost totally bled out, right? Sorry to use a gory analogy here, but the time to save their life is immediately, right? As soon as they get stabbed, bandage them up, put pressure on it, take them to the hospital, right? If they've already bled out, there's not really anything, the best doctor in the world is not going to be able to save them, right? My point is, you got to adjust when the trade still has a chance to live, right? So how will you adjust a fly if fixed drops 100 points the next day? Yeah, so that does happen, and that's the danger of income trading, right? So with range bound trading, the enemy of us is hold on a second, I gotta let my cat in. One sec. Cat's been screaming at me the whole time. Yeah, what hurts us is large market moves. Okay. So with a way to protect against that is we stay out when the market is, too volatile, or we just stay longer term, right? I encourage you to, if you're going to get into the field of income trading, you can download like data on SPY and just graph like the gaps, right? The daily gaps from close to open for 10 years. And you can see like, most gaps are below 1%, right? You don't get that many 2%, 3%, 4% gaps, right? That those happen very infrequently, right? And when those do happen, it's usually when there's a lot of volatility in the market, right? So usually you have some sort of warning signal when the weather is getting bad, and you need to be, more careful with your risk. But yeah, I mean, and when you do stuff like 15-day butterflies, that's why I keep my trades small, right? I mean, the times when I've got hurt most is when I had too much capital allocated in like a 15-day calendar, 15-day butterfly, and the market just gaps down really strongly, and there's just no way of recovering, right? It opens up and I'm at an 18% loss on the position. There's not really much I can do about that. At that point, the only thing I can do is either cross my fingers, wait for it to come back, or close it out, right? You don't want to be in that position where you're basically crossing your fingers, hoping for the market to come back in your favor, because it's not, at that point, it's not trading, right? It's just hoping, right? So, all right, going back to the Discord, there's a few more questions that I'll go over. Let's see here. JK asked, do you typically get open interest, both puts, calls? No, I don't, but like I said, it can make a difference with respect to liquidity. So I do stick with OTM options when I can for the long legs with iron butterflies. Let's see, you structure this based on QT levels. I went over that. Yes, I do sometimes for adjustments. B. Perez asked, what is rolling the position? How's it done? So, the adjustments that I showed where you roll the call spread or roll the short call, those are rolling, right? But if you're asking about rolling like further out in time, no, I don't do that. Not to say that that's wrong to do, it's not. But I think rolling out further in time can look a little more complicated. And usually when you hear people rolling a trade, they're doing something like, I think, they're rolling a credit spread or something. Let's say they open a credit spread, the market's moving against them, it's approaching their short strike. So they roll out further in time. Well, at that point, like I said, at that point, you're in finger crossing mode, right? And you're just basically buying more time for the market to move back in your favor. And I don't like being in that position because to me, that's not trading, right? So I'm never really in a position where I need to roll out further in time. I manage the trade within the same expiration usually. And keep it under the 10 and keep the delta risk small. Let's see. Okay, I think I've covered most of the questions. Anything else?
Yeah, Seth, I think if you're pretty much good, I can just take over to kind of wrap things up.
Oh my gosh, look at yes. Yeah,
Oh,
look at the futures.
I meant to have my futures account open. I wanted to take a trade tonight. What are we missing here?
Wow, it's a big gap down.
Let's see.
Yeah, I'll stop screen sharing. You take over, Bryant.
Okay, yeah. Let me just, I'm checking the futures for a second here too. Yeah. So guys, I mean, right off the back, I don't know if you guys would have gotten a chance to see the YouTube video. I mean, the video that I released about an hour before this webinar, but I was just talking about that with you guys, that we're seeing all of the bearish divergence in the algo flow. And I was trying to let you guys know, like, you try to move away from thinking about what's going to happen in the next 10 seconds when you're looking at all of these divergences. Like this drop down, the algo flow was saying 420, 430 after 11 a.m. for the entire day on Friday. And you're sitting there trying to scalp 0-day puts. It's like you're almost missing out on the bigger picture. It's like, why waste your time with these 0-day puts, hoping that the market will pull back in the next 2 seconds because that's your trade. And then you wake up on Monday and the market's down at 4:30. You kind of missed out on the opportunity in front of yourself versus doing something like an out the money put calendar spread or something like that. Or there's ways you guys have access to so much more information than you would have ever had, being in Quant Trading App with the different algos. You're almost missing out on the opportunity. Or trading the futures, if you have a futures account, getting, being short a futures contract on Friday, you can capitalize on a move like this. And I know a few of you have opened up your futures accounts, and you can also trade options on the futures. There's a lot of opportunity here, aside from just, I lost money on some 0-day puts because it didn't go down right away because everything said XYZ. Let me share my screen actually with you guys, because I do want to point a few things out here. But don't want to get too distracted by the futures, because I don't want to end up trading until midnight tonight. Share screen, share. Okay, can you guys see my screen?
Yes.
All right, and let me just pull the chat back up. Just going to be pretty brief here, because I think this is a great webinar, Seth. I think you covered some gold and stuff. This is definitely the type of webinar you guys are going to want to revisit, and definitely take notes as you're rewatching this. And there was just golden nuggets there for Seth is sharing his one of his 4, personal strategies that he uses to trade, and it's always in rotation. So it's definitely something that you guys should really be grateful for, as well as seeing different styles of trading. I think I've mentioned in a couple of webinars that, if Seth is, correct me if I'm wrong, Seth is about an 85% non-directional trader and a 15% directional speculative trader. I would label myself more of a 50% non-directional and a 50% directional. I'm more of the hybrid, where Seth has found the consistency doing what works best, and now keeping his 15% of his trades to just some speculative stuff. You can kind of still take a little bit, because if you guys, I just to make sure you guys understand, if I'm running, you guys might see me running a 2-3 day till expiration butterfly, but the trade in which I'm running is nowhere near the trade that Seth is referring to with an at the money butterfly, because a few of you guys have asked me that also on a couple of the last webinars. It's like, how do you gauge your profit target and things like that? Like, I could be saying my profit target is actually about 300% return in which I'm looking for, but that's because my position size is probably about $150 I'm putting on the trade, and I'm essentially, my risk management is the entire position. So it's either I'm going to lose the $150 or I'm looking for about a 300% return, because I'm looking to be rewarded for the risk I'm putting on. And the risk I'm putting on is by trying to decipher the direction that the market's going. So you're rewarded for choosing direction. So if I'm looking to enter a butterfly spread down here, and I'm saying I'm targeting, midpoints from QTA, so 430, we'll say 435, there's no way I'm looking for a 10% return on the butterfly, even though it's a butterfly, but it's two different things. So just make sure you guys, the biggest suggestion I can have to you guys is you have to play around with what you're learning here and figure out what works best for yourself as well as your style, because there's so many different ways to trade. And that's what's beautiful about the market. And another suggestion is to, Seth showed, his 10 lots and being in 10 different contracts for the SPX. Like, obviously that size is going to intimidate you, but that's why the SPY is such a beautiful thing. You're supposed to play on the SPY, which means you should not be focusing on, if you're getting 10% return and you're only using $200 in margin every time you run an iron fly on the SPY, don't be discouraged at the fact that you're only making on average, call it, $20 or $30 after, your wins and losses. It's not about that for your first year. Like, Seth didn't get to where he's at now, focusing on the fact that, oh, I'm only making 5 to 10% on average, at the end of the year. It's about proving to yourself that you can commit to a trading plan that returns these types of expected results, because the expected results is what makes it an income-based strategy. That right there is what's golden. Same thing if you work a 9 to 5 or you clock in with your employer, you're not concerned bi-weekly, every 2 weeks you get a paycheck, because you're showing up and you're doing the work. If you're doing an income-based trading strategy, you're rewarded for doing the work consistently at the end of 52 weeks, as long as the market is not, just doing a full ATR down every day. You're going to be profitable, because you're in a sense mimicking what's going on with the SPY. And something you should always strive to have your entire P&L curve look like it's something like the SPY. The SPY is, if you have a bad, few months trading and this is what the market looks like, you don't get mad at yourself, because the chances are there's a few other hedge funds and a few other, portfolio managers that are struggling also. But the SPY looks like this and you're struggling, then you're doing something in a sense wrong. If you're losing money during this market, then you can't be necessarily upset with yourself, because there's chances are there's a lot of other portfolios struggling. Same thing with this. You can't be mad at yourself. And then the same thing with what we're experiencing right now. This is a very difficult market for a lot of new traders. And you need to understand that this is when your expectancy to make outsized returns should be very low. This is the perfect environment to experiment with something, because what's happening right now is there's going to be a lot of new traders that are coming in, seeing what experienced traders are doing, thinking they could match those same results, but the market is not fit for newer traders. Like, this is the, the classic saying of, if these are rough waters and you're a new sailor, your success of sailing from one place to another place is very low, and you don't want to blow your account up during this type of trading market. However, if you can learn to just navigate the seas during this type of climate and this weather, once things surface back out and the market is more like this, that means this will be easy to you. And that's what you want to be able to do. So you want to take advantage of what you can learn. This should be a challenge for yourself right now. And the only way you'll be able to stay long enough sailing these seas is if you size down and you're not focused on, oh, I only made $150 this week, or only made $200. Like, listen, if you can make $150, $200 a week right now, and you have a $2,000 trading account, which is the average new market participant has a trading account size between 2 to 5K. If you're averaging about $200 a week right now, you're pulling in close to, $800 a month, without commissions. You're doing phenomenal. Like, disregard these outsides expecting to see $5,000 returns every month, and that'll be golden for yourself, and remind yourself of that. So the opportunity, if you can trade and you're looking to dive into using some of this new information that you're getting and trading styles, understand that and stick to the SPY, guys, and just do to run some of the iron flies on the SPY to put in perspective here. If you were to just run one right now and you're doing, let's go with we'll do like a 435, and we're saying you want to go 10 points up to the north, and we'll say 10 points down, and let's pull this into 19 days till expiration, or let's go a little further out and say 29, right? This is the max loss. This is your margin on this type of spread. So you can, if you choose to, you can say like, okay, let me just bump up to at least 2. You can play with this type of, position size right now, even with a $1,000 account. As I had showed you guys back in January, I intentionally had funded the Robinhood account with $500 to show you guys how you can run these iron flies and you can run butterflies. And I was showing you guys, 60% returns, 50% returns. Yeah, it was just $20. It was just $35. But with a $500 account, you can still do this. But the point is to be able to just maintain the consistency and not focus on necessarily what everyone else is doing. The point is to be able to condition yourself and train yourself in a sense here. And to touch on another subject regarding the QTA levels, we don't know who iPhone is. I'm not sure whoever posted the question, iPhone, we don't know who you are in QTA in itself. But regarding the gap down, that's always a fear. So like a gap down like this, I'll get you guys the data. I'll actually put it up on the QTA site because we have a little bit of that information regarding, that's what the if we go to the open, high, low, close table, and we actually we can pull up the SPY, but I'll keep it to the we can pull up the SPX, but I'll keep it to the SPY just for now. And if we were to go to the open, high, low, close table, a lot of the information, if we jump back to 2021, that's what the change between closes table is right here. And that's what's telling you the average. So this is based on a weekly time frame. So about 6 points is the change between weekly closes on the SPY for last year. I'll get you guys the information so you guys can see what it's like on the daily time frame. And I'll put that measure up for you guys right here. So you can get that stats on how what's the average in terms of points that the SPY moves. But don't let these types of gaps intimidate you from taking these directional trades, because as scary as the market is, look at we have one pretty outsized gap right here, but there's not really much of a gap here. We have another one right here. We have like essentially no gap, not really much of a gap, not really much of a gap, and then we have this one gap here. And this is during an insane market. So we have one, we'll say 2, we will hardly count this one. So this is 1, 2, 3, 4, 5, 6, 7, 8 days. Out of 8 days, there's maybe 1 or 2 in 8, and this is during on unusually large market moves, and you guys can still see it's not that bad, and if you can tell yourself you don't need to be afraid of, yes, the market can in any given day have a massive gap down like this, but you can't let that shake you out of at least trying. And over the long term, it's all about managing the risk. And over 1,000 times of doing something, what's your expectancy and what's your probability of success? And it will be higher than anything. And then Seth mentioned something: you can't just run a couple butterflies and then they not work out for you and say like, oh, the butterflies are not for me. This is something, it's the last of the spreads that I took my own time to get around to. The calendars is always my favorite, just a personal affinity for the calendars. But understand, if you can understand butterfly spreads, you're trading at the level of the highest level of option spreads based traders, and it is the favored amongst almost all of them because of the flexibility and how you can use them in any market environment. That way you can make them unbalanced, or the way you can make them, you can short 3 of these and buy 2 of these, and one of, like, there's so much insane flexibility with them that the sky's essentially the limit, that you should almost be excited to start playing or experimenting, and not saying, oh, I'm going to make $5,000 because Seth made $5,000 this month doing butterflies. You can't have that, expectation. And regarding the QTA levels, when we're at the 2 sigma levels, these are not the places in which you would want to open up at the money income-based strategies, because it's already implied that we're going to have a big move if we're at these levels, because the market is not going to want to stay around these levels, especially later in the week. So if the SPY, tomorrow we have our new levels for the week, but if the SPY is opening up at 2 sigma tomorrow, because we're already gapped down so huge, you can't expect, tomorrow to say, I'm going to open up an at the money calendar. It's not, an at the money or butterfly. It's probably not the best strategy to use. You're going to want to have some sort of stability, presents itself in the market. You should be thinking about, if anything, can you now turn on your directional hat? And we know if we're at 2 sigma support, you should be thinking about, as I tried to warn you guys all the beginning of the week, SPY below 2 sigma, expect us to go up, just because of, I spent an hour and a half explaining why that was going to happen, not only on the webinar, but the video that was released today. If you can expect that the SPY was going to, end up closing somewhere around here, something that I do for myself is say, either I'll divide up the prices. So I'll say the market is more than likely going to close within here, more than likely, right? More times than not. It's definitely going to close within here more times than not for this week's time frame, which means if we're below here, the SPY is where it should not be. So I'm definitely going to look to put on some sort of a directional bias to the other way. If we're somewhere between here for a day or two, then I'm definitely going to feel a lot more confidence in my non-directional trades, because again, I'm just sharing a little bit of the difference between someone that's a hybrid, that I'm not only putting on non-directional trades. This is my method for when I feel safe to put on a non-directional trade. So the butterfly in which I had shared, the iron butterfly in which I had shared, was targeting 430, and I shared that within the chat, and I was showing with you guys there was no need. I was not afraid to open it, and me being not afraid would say something, again, as a hybrid based trader, I'm not going to have the same confidence that some of you guys might have saying, the same confidence in terms of what Seth might run. But this is the iron fly, which is open here on the SPY for March 18th, looking for a 10% return. So the range in which I gave this one here, I was targeting 430. It's where the SPY was, feeling relatively safe that even if the market was to come all the way down here, it's just based on where we've already come from, we're more than likely going to come back up to at least, I had the expectation that max pain was going to be somewhere in this vicinity. So for myself, if I'm thinking that the SPY is either going to be somewhere around here on Friday, somewhere around here on Friday, or I will divide it up. I will use, say for example, if I think the SPY is going to be in this upper quadrant here, because essentially we have 1, 2, 3, 4 quadrants. If we were to, I don't think quadrants would be the right term, but we'll say 4 sections. You guys can think of this to help assist as you're now starting with the visual cues on your chart here, if that makes sense. Here we have 1, here's space 1, we have 2, we have 3, and we have 4. So it's going to end up in one of these these spaces, right? This is where a little bit of, if you want to introduce some sort of your own TA, or you have your own systems or methods, or you have your own other indicators, or whatever it is, you're the way you trade, and you're looking to see if you're putting on a trade targeting OPEX. I start by thinking, do I think the SPY is going to close within here? Do I think the SPY is going to close within here? Do I think the SPY is going to close within here? And that's something, if you guys have noticed, the past 3 out of 4 Friday expirations, been able to just kind of get almost to the T where the SPY is going to close. I'm not necessarily predicting the future, and I'm by no means, just as a developer, I have a little bit of an edge because I'm knee deep in code all day long. So I'm staring at all these numbers with the option OI as I'm coding, and things just come to me. But I just wanted to share that with you guys to understand. I'm generally just saying my expectancy was the SPY being somewhere in this vicinity when we were down here. So that's why I entered in the 430 calendar, but you very much so could have entered in a 430 butterfly, meaning you sell 2 of the 430, you buy the 440, and then you buy the 420, and this being your structure here. So these are the wings of your butterfly, and this is the body of your butterfly right here. And you just need to SPY anywhere in this vicinity to be profitable, as we're all the way at the extremes, because when we're at the extremes is where we have the greatest edge. The things are going to want to return, in a sense, to their mean, or where they should be. So you're widening your range of profitability. But the thing is, you don't need to hold until OPEX, which is options expiration. You're just holding until maybe it comes into your body. So as it hits your body, you're essentially closing the trade. So we were at 4:30 for 30, 45 minutes on open on Friday. And from this day here, Nick, I know you took a couple of the swings with me here, and it was just Friday was essentially just a payday for us, because we just set ourselves up from early in the week saying SPY is going to end up probably being around here, and then when we're down here, this is just a gift. It's like, okay, this is the opportunity now to maybe just get some really directional trades and add some extra P&L and not have to look at every single tick and burn yourself out, and take a step back, zoom out, and really focus on what's happening. So with what's going on right now, with where the futures are, if we jump over to that chart, it's not surprising to see what we're seeing. So here's the futures, right? And here we are smack dab in this vicinity. But a lot of you guys were curious or questioning why. I mean, this is the video in which I'm referring to, but I'm not sure if most of you would have gotten a chance to check that out, because obviously it came out right before this. But here's a little bit of the question. It's like, okay, why is the algo flow? Well, here we are at 428. There was a lot of hedging going on Friday. This is just showing us that there's a lot of money going into puts. It doesn't mean the market needs to pull back because it's Friday, because you think it's going to pull back. It's not the way the market necessarily works. Money is buying up the SPY as they're also protecting themselves by buying a ton of puts. And we can see this right here because there's an expectancy of some sort of a pullback. So now the SPY is right where this is. So if you lost, money trying to scalp some puts on Friday, you just missed out on a huge opportunity here. Now, we don't know where the market's going to open on Monday. That's besides the point. All I'm saying is, take a step back and think about things from a larger time frame. Think about where it's likely to go, and not just because it didn't go when you wanted it within a couple minutes. And that's kind of the conclusion for now. So any final questions? Amazing video. Would you cover? Yeah, in the future videos there, we'll definitely, I think Seth will cover his take on the calendar spreads. There's definitely a few. I expect to see a lot more calendar spreads based videos, even for myself, because again, the calendars is my bread and butter, my favorite. Like a put calendar spread like this is going to benefit on a move like this tomorrow, because the VIX is probably going to be up. The put calendar spread is going to benefit because of the directional move, and then also the time that would have passed by from Friday to Monday. And I think I've also told you guys that you can, when you run your calendar spreads, I first started off with calendar spreads because not only were they pretty not very expensive, but you can make them really tight in terms of the days, just to experiment. So that way you can keep the cost of these things, below $50 sometimes. And then you can just start experimenting with a couple of these, maybe $20. So on Friday, if you bought this put calendar spread right here, you would have been getting this for below $50. We'll see where this opens up. If the SPY opens up somewhere here tomorrow, this is going to be an amazing win. Or let's just say you just want to swing for over the weekend because you think the pullback's coming, but you don't want to be in naked puts and you want to give it a little bit of time. There's ways to start playing with these things without too much expense to your pocket while you're learning. And I would encourage you to do it live as opposed to paper, because you need to get that feel for what's happening live. So that's the conclusion to this, guys. And as usual, we'll keep you guys posted on when the next webinars will be in the webinars panel, and looking forward to hearing from you guys this week. Enjoy, everyone. And thanks, Seth.
Yep, you're welcome. Thanks, everybody.
Later.
Take care.